Hi, this is a short screencast on the impairment of goodwill, and we're focusing here on the technical article which is up on the ACCA global website, and this is relevant for both the F7 financial reporting and the P2 corporate reporting exams. Now, under the IFRS 3, there's two ways of calculating goodwill. There's the proportionate method, and then there's the new method, which is also known as the full method. Now, under the original method, the proportionate method, you took the goodwill as being the fair value of the consideration that was given by the parent for the parent's share in the fair value of the net assets. So basically you'd have this consideration and take away from that the fair value of the net assets, giving you the goodwill that was attributable to the parent. Under the new method, or the full method, you're calculating the goodwill not only attributable to the parent, but also to the non-controlling interest. So here you're taking the consideration that's paid, the fair value, but also adding to that the fair value of the non-controlling interest, which is usually just given to you in the question. From this then you carry on just as the same and take away the fair value of the net assets. This gives you then the total goodwill, so not that just of the parent, but then also of the non-controlling interest. So just if we look at an example here of calculating the goodwill, we're given some details. We're told that there is an 80% interest that was acquired by Burra, and it was for the consideration of $500. The fair value of the net assets is 400, and then the fair value of NCI at the date is 100. So there we can see that for the full method, or for the new method, we've been given the fair value of the NCI, to which we need to add to the consideration that we have paid. So if we just take a run through as to how this is calculated. So under the proportionate method, we have the cost of the investment, which is the 500. These are just figures taken straight from the question. And then we take away the parent's share of the fair value of the net assets. So the net assets are 400, and we're only taking 80% because that is the amount of the interest that we have within this company and within this subsidiary. This is giving the goodwill that is attributable to the parent of $180. The next example then as the full method of goodwill. So again we have the consideration that was paid, and that's the $500, which is the same just first step as in when you're calculating the proportionate goodwill. And then to this we add the fair value of the NCI, which is the £100, which again is just given to us in the question. From this we then take the fair value of the net assets of the subsidiary, the 400. So the difference then on this line is that in the proportionate method we took 80% of this because we were only calculating the goodwill attributable to the parent, but from this we're taking the 100% of the goodwill. This has given us gross goodwill of $200. This then can be split just as to what is attributable to the parent and what is attributable to the NCI. And we can see here that it is $180 to the parent and then $20 to the NCI. So those are just the two different ways in which you can calculate goodwill. And this is something that you definitely need to learn. You need to learn the distinction between the two because it crops up time and time again in both the F7 exam and the P2 exam. The next thing that you need to be thinking about whenever you're dealing with goodwill is, has there been any impairment? So what do we mean by impairment? Well, an asset is impaired when its carrying value exceeds the recoverable amount. Now, it's paramount that you understand the difference between the carrying value and the recoverable amount and what we're meaning by recoverable amount. So this amount is the higher of the fair value less the cost to sell and the value in use. Now quite often you'll be given what these figures are in the question, but other times you may have to do some slight calculations to derive these figures. So if we just have a look at the example that we are given, a company has an asset that has a carrying value of $800. This asset has not been revalued. The asset is subject to impairment review. So here we need to determine what is the carrying value. $800. We are told this. The next figure that we're given is that it could be sold for $610 and there would be selling costs for $10. So here then, where this is broken down, it wouldn't necessarily be done like this in the exam. The fair value less cost to sell is 600. The next point we need to determine is what is the value of use. And again, we are told this is being $750. So if we just go back to our definition, that an asset is impaired whenever a carrying value exceeds the recoverable amount, and the recoverable amount is the higher of the fair value less cost to sell and the value in use. So between the two points over here, the 600 and the 750, the higher of that amount is 750. So the value in use is going to be 750, and that is going to be our recoverable amount for this impairment review. So what we then need to do is just to determine whether the asset has been impaired, and that's done by comparing the carrying value of 800 to the recoverable amount of $750. So we can pretty much see straight away that yes, the $750 is less than 800 by $50. So the impairment loss that's going to be recorded is 50. So this must be recorded within the financial statements, and under the proportionate calculation of goodwill, this is going to just come off the goodwill itself, and it won't have an effect on the non-controlling interest. Whenever we're taking a look at the full goodwill method, this is then taken against not only the goodwill within the parents within the consolidation statements themselves, but it also affects the non-controlling interest. So why would you impair goodwill? Goodwill, there's going to be very different indicators that that goodwill, or in fact any other asset, has been impaired. So if we just look here, there's a couple of examples that the examiner, or the person who wrote this technical article, has given us. So there's external sources such as changes in technology, increases in market price, and company share prices. Internal sources will be just obsolescence or physical damage, and perhaps there's been restructuring, or maybe there's just general worse economic performance than expected. So if you're reading a scenario question and you see anything that that runs along these external and internal indicators of impairment, then you need to just try and think to yourself, does this show that this maybe has been impaired? So whenever we're talking about the impairment of goodwill, we need to think that goodwill in relation to a subsidiary that has been acquired is not going to be seen to be just a figure in isolation. And whenever we are testing for impairment, we need to be thinking about it as a cash generating unit. So we need to be thinking about the goodwill itself, but also the fair value of the net assets of the subsidiary. So then just the difference between the proportionate goodwill and the full goodwill method. So whenever there is an impairment review, we need to gross up the goodwill in order to ensure that we are comparing this cash generating unit as a whole, because as we were discussing earlier, we've only actually calculated the goodwill that's actually applicable to the parent. So we need to gross this up. For the full goodwill method, we don't need to do this grossing up because we have the full goodwill that is attributable both to the parent and also to the non-controlling interest. So this step isn't actually needed. So we have another example here, just the impairment review of proportionate goodwill. So just reading this through, an impairment review is being conducted on a 60% owned subsidiary. So at the moment, the carrying value of the net assets is 250, and the goodwill attributable to parent is 300. The recoverable amount is $700. So then just the first step, we need to gross up the goodwill. So that's just basically, multiplying it up to ensure that you're getting the 100% rather than the 60% we've calculated, which is the $300. So that's your first step. You need to ensure that you're grossing up this goodwill. The next is just the same as we discussed earlier. There's a comparison then between what the carrying value is and what the recoverable amount. The difference being here is that you take the goodwill, which is your grossed up goodwill of 500, and then also just from the questions, the net assets. Adding these together gives $750, which is the total amount of the cash generating unit that you're going to need to compare And we can see that there is an impairment because the recoverable amount is $700. So that leaves $50 then as an impairment loss. So this impairment loss needs to be recognised first against goodwill, and then if there's anything else, then against the net assets. But there's not going to be an effect on the non-controlling interest because this is the proportionate goodwill method. If we just look across the page, then we have the calculation of this if it was for the gross goodwill method. So there's an 80% owned subsidiary in this point, and at the date of the impairment, the carrying value was $400 and the gross goodwill is $300, and they split it then between $40 then being attributable to the non-controlling interest. And then the recoverable amount, which is what you're comparing it to, is the $500. So again, it's the same type of situation. You need to ensure that you have, the total of the cash generating unit, which is the goodwill and the net assets, and you need to then compare this to the recoverable amount. So here we have the solution. So the carrying value is the net assets, the goodwill of $300, which has already been grossed up, which gives $700. The recoverable amount of $500 leaves an impairment loss of $200. So you can see that it's just the same type of formula, the same principle. The only difference really being is that you don't need to gross up the goodwill. The allocation of this loss is slightly different as well. So we need to determine the loss that is attributable to the parent and the loss that's attributable to the non-controlling interest, because under the full goodwill method, this is going to have effect on the NCI. So just basically, it's 80% of 200 and 20% of 200 for the NCI. So the impairment and the calculation of goodwill crops up time and time again within an exam, and you need to be 100% sure as to what the different methods are. So you have the proportionate method and the full method. Proportionate method's just the straightforward or the old version, where you're just comparing the fair value of the net assets that are attributable to the parent against the consideration that was paid for it. Full good method then includes the fair value of the non-controlling interest, and in this part you're calculating the goodwill that's attributable to both the parent and the NCI, the non-controlling interest. Whenever you're doing an impairment review, you are determining whether the carrying value is less than the recoverable amount, and the recoverable amount is the higher of the fair value less costs to sell and the value in use. So you need to ensure that you know which figures these relate to and how to determine if there is an impairment. Again then, if there's an impairment loss, you need to determine whether it's the proportionate method or the full good method that's been used. If it's proportionate method, then you need to just allocate this against goodwill first and then net assets should there be any additional loss to allocate. And this then would not affect the non-controlling interest. The full goodwill, you'll need to allocate against goodwill and then also the other net assets, but this does have an effect on non-controlling interest. Read through this article again yourself and try and do the examples without looking at the solutions, and you'll have a better understanding as to what effects there are for the different methods of valuing goodwill and then also how to treat the impairment for both of these methods. Thank you.